Welcome to another video on the Modern Business series. We are still in accounting principles and we're up to chapter 10. Now remember, these books are from 1936, copyright Alexander Hamilton Institute. So a lot has changed between when the books were written and what we do in accounting now. But the series is to show that although some of the methods may have changed, the process and principles behind them are still effectively the same. So chapter 10 is adjusting entries, and it's very much related to chapter 9, accruals and prepayments, because adjusting entries is what you do with your accruals and prepayments. If you haven't watched that, maybe head over so you can understand what those are. And then chapter 11, which we'll cover in this video as well, is closing the books, which used to be in 1936 a very manual exercise. Remembering everything was done on paper, all the calculations were done manually, there was no computers, there was no software for your accounting, so things have changed and these processes have become easier, but we're effectively still doing the same things. So it's really good to understand what those processes are. And also just a bit of a caveat about these adjusting entries. This is something specific for accrual accounting. So if you are operating cash basis accounting, they're probably not going to be something you need to deal with. Although closing the books is, but the adjusting entries isn't. So closing the books is actually the introduction to adjusting entries, because that's the aim of what we are doing. So when all the adjustments have been made in the ledger accounts for accruals and prepayments, the books are closed and the profit and loss account and balance sheet are prepared. The term closing the books is a technical expression pertaining to the accounting procedure at the end of each accounting period. It involves the process of bringing the adjusting entries into the accounts, carrying all expense and income balances into the profit and loss account, and the final balance of the net profit to the capital account. And there are several steps in this process that require detailed explanation. Now, we're not going to go into the detailed explanation in this video because it will get very, very dry and very technical. But effectively what we're doing is we're making adjustments to the accounts to ensure that the period we're reporting matches the income we've received in that period and the expenses we've incurred in that period. Then we're going to add some totals in our profit and loss to find out what the total profit or the total loss was, and we're going to adjust that into our capital account, or into what we now call retained earnings, so that we reset our books ready for the beginning of the next accounting period. We don't want to be carrying all these historical transactions for years and years and years in the same books, when we can kind of draw a line in the sand. That was the end of the last accounting period and now we're into a new accounting period. So that's what adjusting entries and closing the books attempts to do. So there is a worked through example continuing from the earlier examples in the books, but we aren't going to particularly go through them in that level of detail, but we will talk about what they are. So in order to prepare the journal entries for the adjustments, it is desirable to proceed in a systematic manner. I think that applies probably to all accounting and not just to adjustments. Immediately after the trial balance has been prepared, remember trial balance is one of the accountant's main tools, the accountant starts a searching examination of each account to determine whether the balance correctly states the condition of the item it represents. She gets the necessary information from various sources outside of the book records. So we're going to be looking at, that's the prepayments and accruals. Does the balance represent the current accounting period, or does it also have impacts from outside the current accounting period? So we'll know that by looking at source documents, and looking at what we have in inventory and those sort of things. So if we have interest or we have loan interest, those sort of things are sometimes outside the current accounting period. So some of the examples they give is goods purchased but an invoice not received, but the goods have been received. A stock take is an adjusting entry. So if you were expecting to have $1,000 worth of stock and you've done a stock count and you only have $900 worth of stock, there's an adjusted entry there needed to match those two pieces of information. Salaries, if they're paid outside the current period but were incurred in the current period. Advertising that may be outside the current period, insurance premiums, interest on bills receivable, and interest on bills payable. So all sorts of different impacts affect what we're going to do. And the book recommends a working sheet, and I'd still tell you working sheets still exist. They are not on paper, but they do still exist because it's a really good process to be able to track through from what the beginning trial balance was, what adjustments have needed to be made to what the final outcome should be. So it's potentially not necessary if it's a small concern, but it's still a good practice. It really is. And when it comes to accounting and calculations, it's always good practice to have a process and something you can refer back to in future. And there are a number of columns, and always with debits and credits. And whenever it becomes necessary to make an entry for an account that does not appear in a trial balance, it is added. So there are new accounts added during this process for your accruals and prepayments. So I'm going to skip over some of the examples, and we're just going to discuss that after these entries have been posted to the ledger, the account balances will correspond to the adjusted trial balance. So we get to what we call an adjusted trial balance. So we have the trial balance from when we've done all the original entries. We then make adjustments, and from that we get an adjusted trial balance, which should correspond with our working sheet for the adjustments we needed. We do create some additional accounts to be used in connection with the adjustments that are temporary. So we have temporary items come through on the balance sheet and to show the adjustments we've made and what impact they will have on profit and loss and the balance sheet. So after the examples, we're basically doing the same process we discussed in accruals and prepayments, but now we're officially recording them into the books so that they can have their impact shown on the financial statements. But before we get to the financial statements, we have to close the books. So we do what are called closing entries. So since the balance sheet reflects the condition of a business, this is chapter 11, it is necessary to analyse each transaction with a view to determining its effect upon the balance sheet. The income and expense accounts are kept for the purpose of explaining the cause for the changes in the proprietor's equity. It is necessary, therefore, to transfer the net balance of these accounts into capital account. When this process is completed, all accounts which have open balances will be listed on one side or the other side of the balance sheet. So we're effectively saying that the major change that we are interested in accounting is what's happening with the owner's portion of the business. Because after all, in order to be a business, you have the intention of making a profit, and that profit needs to go back to the people that own the business. We're not talking about not-for-profits, we're not talking about community organisations, we're talking about business, and one of the tests for business is an intention to profit. So after this accounting period, we need to make sure that these changes are being reflected into the owner's equity or the proprietary accounts. So in the last chapter, we considered the adjustments necessary to make the balance in every account truly represent either a balance sheet item or an item of income or expense. The adjusted trial balance is a list of open account balances which may be classified into the two groups. So it's just saying that everything you see in accounting is either in profit and loss sheet, income statement, or in balance sheet. So remember, profit and loss is our income and expense accounts, and then balance sheet, assets, liabilities, and owner's equity account. So that's the distinction between the two. And an individual account can only fit into one of those two categories, balance sheet or income statement. So we then go through the method of closing the account. So the final step in the closing process consists in transferring the balances of the income and expense accounts through the profit and loss account. So we do create an account for profit and loss to the capital account. So we're reflecting that profit that's been made into the balance sheet account, into the capital account. The owner's equity, proprietors, interest, capital are all the same thing. We just like to have multiple ways to describe them. So the balances of the income and expense accounts are transferred to the profit and loss account by journal entries. These could be made directly from the adjusted trial balance, but inaccuracies cause an additional method to be used, which is another working sheet. Now, to be honest, we don't really need to do this in a small business, and often your software will actually take care of this for you, because you enter in your software when your financial year end is. If you're keeping your bookkeeping up to date, at the end of the year, the software can and often does make a calculation of what that retained profit should be that is transferred to the owner's equity account. The other part of keeping this up to date is to ensure you're entering the drawings or withdrawals of the proprietor into the account as well, which will give you then an accurate capital or owner's equity account. So we're going to, in the closing process, do journals to transfer all the expenses and income into a single account. So we're going to add up all our income. In this example, it is £9,206, 1936, even though it's an Australian book. And then we're going to add up all of our expenses. So we've got cost of goods, salaries, advertising, etc., etc. And then that is £8,908. So we're going to then transfer the difference into the profit and loss account. We create a new account for profit and loss that's just giving us what either the profit is or the loss is, and then we can close that into retained earnings. But effectively we do that, so we add all the expense accounts so that we can give them a zero balance, so that at the start of the next accounting period there's no balance in the salary account. We want that to be zero so we can see the balance at the end of the next accounting period is just the accounting period we want to look at. We don't want this running balance year on year, else it will be really difficult to analyse what's actually happening in the business. So effectively, after all the closing entries have been posted, the only accounts that still have debit or credit balances are those which appear on the balance sheet. So remember, we're not going to close an asset account. We're not going to close a liability account because they are running totals. You can't just wipe out what you owe to somebody or what somebody owes to you. So those assets and liabilities and owner's equity from the balance sheet, those accounts stay active. So we're just closing out income and expense accounts. So, but it is important that the balances in the balance sheet accounts correspond in amount to the item's actual total. So we don't want it to be inaccurate, so that's why we make those adjusted entries. And then the book goes on to tell us about what we call ruling the accounts, which is the physical process of going into the books and ruling with a pen onto the account so we can see easily where the end of the accounting period is. But that's honestly not necessary anymore unless you're an accounting student and you are doing this. Practice by on manual sheets of journal paper, which was a very fun exercise, honestly. And then just before we kind of finish up this video, the frequency of closing is important. So the normal accounting period for closing the books is 1 year. So it's not something we do every accounting period. We don't every month go through and close the books because that would take an extremely long time. We don't necessarily need to be transferring retained earnings into the owner's account every month. So it is normally just a once a year exercise. So overall, what is the process? There are 8 distinct steps in the process of closing the accounts after the trial balance has been prepared. They are as follows. First, each account balance in the trial balance is analysed to determine what adjustments are necessary to bring them into conformity with the facts. And the facts being only those transactions pertaining to the current accounting period. Second, a working sheet for adjusting entries is prepared. This includes a trial balance, adjusting entries, and an adjusted trial balance. Fabulous. Then we actually journalize the adjusting entries. So those entries we've determined to be necessary, we enter them into bookkeeping. Then we post those. That's just another thing. In 1936, that was 2 steps. Now I'd say that's definitely a 1-step process. Then a working sheet for closing entries prepared, in which the balance sheet items are separated from the income and expense items. Yes, that still happened. Then closing entries are journalized and posted, again done in a single step now. And ledger accounts are ruled and balances are carried forward to the next accounting period. So only we're going to carry forward assets and liabilities. So if we have an inventory account, that balance will be carried forward. Loan accounts, accounts receivable, accounts payable, those accounts carried forward, but only with a balance amount. So we're going to see an opening balance or a starting balance as we refer to it, and then the transactions from that period. So we're not keeping all those previous transactions, we are ruling those out to the previous period. And then what happens? So after the books are closed, the accounts are in condition to receive the entries resulting from the next accounting period, and the same series of operations is carried through. So this completes a cycle of operations that is repeated in each accounting period. So just to go back 1 step and remember, why do we do this? So the accounts are maintained for the purpose of obtaining information that can be used for management purposes. This phase of accounting involves the preparation of financial statements that are readily interpretable. So we're not having to go through and figure out, is that the right total? Do we have things from next year? Do we have some items carried forward from last year? The profit and loss statement and balance sheet should be prepared in such a manner as to convey as much information as possible. And that's what chapters 12 and 13 go into, the profit and loss statement and the balance sheet. So we've got to the end of the accounting period. Like I said, this video was probably really technical and quite dry, but it is important, as I said, to understand the underlying principle of what's actually happening and why it's happening. I'll see you for chapters 12 and 13 next time.